Fibonacci Forex trading can be a very profitable way to trade, and we at Forex Trading Coaches want to take a quick second here to show you a way that you can use the Fibonacci retracements for entry and the Fibonacci extensions for targets once you have entered those trades. It's a quick 5-step process, so let's go through it and let's get started. Okay, so for the first step, you want to make sure you're identifying a significant area of support and resistance to draw your Fibbo onto. So let's go to the charts and talk a quick second about how to do that. Whether you determine these significant levels on your 4-hour chart or your daily chart, or whatever you choose to do, whatever time frame you choose to do, you want to identify those more significant areas of support and resistance that price has been holding for quite some time. Oftentimes those are these significant lows that you can see that have big reactions off of them. Nice big reactions off of the lows. There's basically two types of support and resistance. The first type is the big low like this, or the big high that you can see that's very easy to identify, this area, this area. The second type is the kind where it's a big high, but it also used to be an old low. So it's an old support becoming resistance, like at this level, or in the future, after you've broken through this old resistance, it becomes future support. So again, sometimes you can see that it's just a bottom or a top, not retesting any level. Sometimes you can see that it's an old top after it's been broken and retraced to becoming a bottom. Okay, those are the two types of areas of support and resistance. The more significant it is, meaning the bigger the move that came after the level was hit, the more obvious it will be to all the other traders as well. So the more obvious, the more significant the level on whatever time frame you're drawing, the better. Okay, now let's move on to how to draw the Fibonacci levels, and that's step number 2. Okay, so when drawing the levels, you want to grab your Fibonacci drawing tool, whatever charting package or software you're using, and you draw from, if you're going to do a Fibbo looking for a buy trade, you draw from the low, the lowest low that you can see of the range that you're drawing the Fibonacci for, up to the high that you can see that you're drawing the range to, the significant high where a nice big move came down. You're not really going to know you need to draw it here until this price holds and starts to fall off. Okay, so you're drawing from the biggest low to the biggest high that you can see over that range that you are determining that you want to draw it from. Also, if you're doing from the sell side, you would draw from the biggest high down to the biggest low that you can see over the range that you're wanting to draw from. Okay? So big significant areas, we have learned to identify them, and now you use them to draw your Fibonacci from the top to the bottom for selling and from the bottom to the top for buying. Okay, time for step number 3. Look for the entry. So we'll talk about how to enter at both the 61.8 and the 78.6 Fibonacci retracement levels. Okay, so once you've entered, or once you've drawn your Fibonacci levels, then you can look for entry. So there's two ways to look for the entry. When price retraces to either the 61.8 or the 78.6, the choice is yours. Those are the two most prominent levels that traders use to enter, for the most part. Some will also use 50%. You can either get in right at price, or like this one, you hits price, it sells and goes down. Nice pips there. Okay. Alternatively, you can wait for a fair amount of rejection candles to come in with wicks like this if you're selling, or tails if you're buying, at the level to prove to you that level wants to hold before you get into the trade. Okay? So either get in right at price without waiting for rejection, or wait for rejection and for price to hang out around in the area before you get in the trade. That's how you enter. Okay, now step number 4. Determine the targets and the stops for your entry that you've already got into the trade with. So back using this example, if you get into the 61.8, if you want to have a little bit more conservative stop in that you're going to be risking less, you can set your stop above 10-20 pips above 78.6. If you want to get in the trade at 61.8 and have the least likely to get stopped out stop loss, then you would put your stop about 20 or more pips above the full retracement level. So if you get in at 61.8, stops could either go above 78.6 a bit or above the 100% a bit retracement. If you get in the 78.6, your stops will go above the 100%. Okay, so obviously on a higher time frame like this daily chart, this stop loss getting in at 61.8 could be 260 pips. This one might be 400 or 500 pips. So if you're going to do that, obviously you're going to want to have a smaller amount of lots in there. Now if you wait for rejection at that level first and then get in, then a lot of times by keeping that stop tighter, you can reduce the drawdown you would experience and reduce how much you would lose if you got stopped out. Okay, that's how you set the stop losses. Now the targets are the 127 and the 1618 extensions. Okay, so once you're in the trade, let it play out, let it go, let it go. Hit your first target, you can decide to get out of the trade, or you can take some off the trade and let the rest go down to the second target. And you can see how by drawing this Fibonacci that it did the 61.8 retrace, hit the first target, and eventually hit the second target to the pip before it reversed. Okay? And interestingly enough, upon that reversal, you could have drawn the next set of Fibos for the buy side, and you can see that it popped up so far to the first target, almost the second target. Alright? So that's how you use the stop losses and the targets for those trade setups. The Fibonacci extensions, the 127 extension and the 1618 extension. And finally and very importantly, manage the trade. Okay, the Fibos are already here, we'll just use them here. Once you're in the trade, folks, and you start to gain some profitability at your 61.8 and your 78.6 entries, you get up 50 to 100 pips or so. If you're using higher time frames, if you're using lower time frames, maybe 20, 30 pips. If you're drawing Fibonacci on, say, a 15-minute range or something. Once you get up a chunk of profit, what we look at doing is taking about 1/3 of the position off the table. So if you got 3 lots, take 1 off, let the other 2 run, and let those profits continue to run towards the target areas. Every time you gain a next big chunk of pips, 50 pips or 100 pips, if you're doing a higher time frame, you might let it go even further, then move your stop again to lock in those profits as you go, which is a way of taking money as the market makes it available to you. Okay, so as it goes up, keep moving the stop. It goes up again, another 50 to 100 pips, move the stop again. It goes up again, move the stop again. When it hits your target, take a little more off and see what happens. You probably would trail stop out for here, but you trail stop out for a whole chunk of pips, right? 500 plus pips on that trade. Alright, so manage the trade. When you get up a chunk of pips, 50 to 100 pips, if you're using higher time frames, move your stop to break even and take something off the table. That right there, folks, that is some secret sauce that will keep you out of trouble a lot of the time. Okay, so these are the 5 steps in review. Support and resistance, get the good levels, then draw the Fibo levels, look for your entry at the 61.8 and the 78.6 retracement areas, determine your targets and your stop losses, and very, very importantly, manage the trade. Now, if you'd like to learn more from us about how we trade and the amazing system that we have, the MACD3 system, along with some Fibonacci Forex trading, go ahead and go to forex-trading-coaches.com. Click on the free 2-week trial. You get 2 weeks free. It's not a risk-free trial. It's literally a free trial. No credit card required. So come on in, folks. We hope to see you in there. This is our standard Forex disclaimer. Please take a second to read and understand the risk. By proceeding to view the video, you agree to accept the risk.